What is the difference between tax avoidance and tax evasion? This is an interesting question. Let's start by looking at the definition. Tax evasion is the illegal evasion of taxes by individuals, companies and trust. In contrast, tax avoidance is the legal use of tax laws to reduce one's tax burden. Therefore, as we've said, tax evasion is illegal and it means you can go to prison. And you may remember a few years ago some high-profile carousel fraud cases of where some unscrupulous people were buying and selling mobile phones and claiming a VAT benefit fraudulently. Let's be honest, no one likes to pay taxes. But, like death, taxes are a certainty and are law. And as they are used by the government to pay for public services, let's not forget about the NHS, roads, schools, local government, etc., irrespective of political views or opinions on how well this money is or isn't spent. It's important. Tax evasion. So, in simple terms, tax evasion is the illegal practice of not paying taxes by not reporting income, or reporting expenses not legally allowed, or by not paying taxes owed and it's an offence. This could be as simple as not putting all your cash that you receive from your customers through your cash till, especially applicable to cash businesses. Or it could be claiming VAT, value added tax, on an expense, but it isn't actually a business expense. For example, buying some building materials which you then use on your home and not in your business. Or not paying over all your employee tax and national insurance contributions that you've deducted from them. Tax avoidance. Tax avoidance involves legally bending the rules of the tax system to reduce current or future tax liabilities by means not intended by Parliament. Examples of tax avoidance are tax deductions, changing one's business structure through incorporation. At one point in time, for example, there was no corporation tax on very small levels of profit for limited companies. So lifestyle business owners incorporated. But clearly, the government closed this loophole. Also, establishing an offshore company in a tax haven. Another example. Now, clearly there's been a lot of work done of late by HMRC to close these loopholes down, and all the publicity that's gone with that of recent times. According to HMRC, tax avoidance often involves contrived, artificial transactions that serve little or no purpose other than to produce this advantage. It involves operating within the letter of the law, but not in the spirit of the law. Most tax avoidance schemes simply do not work, and those who engage in them find that they pay more tax than the tax they attempt to save, once HMRC has successfully challenged them, of course. Over recent years, we've seen some very high-profile cases of pop stars, actresses, actors, footballers, etc. being challenged. So how do tax avoidance schemes work? Well, there is a disclosure of tax avoidance scheme, DOTAS, which came into operation a number of years ago now, which makes anyone marketing a scheme, they have to disclose it. Or there could be fines for non-disclosure, HMRC say. And they often say, if it sounds too good to be true, then it probably is. But then they would say that, wouldn't they? The moral of the story is, you need a really good accountant who knows their stuff to ensure that you stay on the right side of the law and don't have sleepless nights. And, clearly, that you're as tax efficient as you can be and you don't pay more than your fair share of tax legally. Beware of trying to save money by doing it yourself, or worse still, getting someone who isn't qualified, because you could end up costing you a lot more than it actually saves you.